how are you going to kick the can down the road from this one? I mean, this is too big. It's a tsunami, which is going to completely wipe out markets, in my view. I think it is a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies because they understand the difference between money without any counterparty risk and currency with counterparty risk. So what they're telling us is, hold on, this whole system is looking a bit dangerous. Let's put it that way. Normally, I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does, and it hasn't. Now, it has actually performed more or less in line with gold, but what's happened is that this is because the gold-silver ratios remain very, very high.
In today's news recap, Trump tariffs could have a massive impact on precious metals prices, but not the way many think. TD Securities' Melik. The newly installed U.S. administration's threats of import tariffs as high as 25% continues to roil commodities markets. And while many market participants are focused on potential shortages of physical gold and silver, that's not where the real impact is likely to be felt, according to Bart Melek, global head of commodity strategy at TD Securities. It looks uncertain. I think that's probably the kindest and mildest thing I can say, Melek said. Recently, we had a so-called blowout in the EFP exchange for physical silver and gold markets, and that was all because markets were concerned about what the tariffs might be. At this point, we are not looking at global universal tariffs, though they may also be coming, as was said in the Oval Office the other day. Right now, the focus seems to be Canada and Mexico. But it's not only the metals market, he added, it's also the energy market, which would be much more important to the broad economy than just the metals market itself. Asked about the impact on the U.S. supply chains from the tariffing of Canadian metals producers like Teck Resources, which sends significant amounts of copper and zinc south of the border, Melek said the U.S. administration could be creating an intractable problem for their own industry. We are a big exporter of zinc. That may very well be one of our largest sources of metal exports directly, and the U.S. certainly is a big customer of it, he said. What would it mean? Ultimately, there aren't that many substitutes. You could maybe get it from Chinese smelters instead. Ultimately, it means broadly higher prices domestically in the U.S. and some sort of market segmentation, a global price and a U.S. price. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
Answer, but this is fundamentally a dollar-based bubble. The reason it's a dollar-based bubble is that the dollar is the reserve currency of everybody. It is the international trade currency. It is the international commodity settlement currency. It is the international currency, full stop. So we see the dollar going higher and higher, higher, because people are now waking up to this interest rate problem. Gradually, I mean, there's still a lot of waking up to do. It's undermining the other currencies. We now get to a situation where, as I suggested, if we see the 10-year maybe go over 5% yield, which I think it will do in the not too distant future, then I think that will take the equity market out. Then, of course, all the debt problems in other places will start being triggered as well. Bear in mind that the G-SIBs in both Japan and the Eurozone have debt to equity ratios, in some cases, of over 20 times. Now, that is exceptionally high, and that's come about principally because of negative interest rates. I mean, the only way in which a bank could protect the bottom line was increase its gearing, because the lending margins were just getting compressed and compressed and compressed. So that's what they did, and they're now left with this sort of enormous debt to equity levels. In America, I guess it's around about 13.5, 14 times. Amongst the big GSIBs, this is. Regional banks are a different story. Now, the normal level at the bottom of a cycle, in other words, once all this is sort of washed out and all the rest of it, is for these banks to have debt to equities of around about 7, 8 times, maybe slightly less even. So it's quite a long way to go, as it were, in terms of bank balance sheets adjusting. Mm-hmm. The problem they have is the only way in which the complete banking system can adjust its total outstanding credit is through their customers going bankrupt, because that's the only way it gets wiped out. Some of it, I mean, the difference, you've got to sort of understand that money supply is actually sort of a secondary consideration in this, because money supply is distorted by flows between the commercial banks and the central bank, because central bank, the deposits, if you like, the reserves, as they call it, which are really commercial bank deposits at the central bank, are not included in the money supply calculation. So, banks can increase their reserves, and that undoubtedly is going to happen, because the Fed will go in there, it'll have to buy bonds, because the foreigners and everybody else on the margin isn't going to want to buy anything other than very, very short-term debt. So at some stage, we're likely to see QE come back. Now that will contract money supply, because what happens is it doesn't destroy the credit; it just migrates from commercial banks into the Fed. Other than that, the only way in which this credit gets destroyed is basically when through defaults. So that's going to happen big time. Now, the value of credit, the total value of credit, will diminish, because you will have losses booked to, sort of market losses on the value of credit. And that is really the way the adjustment is going to happen. It's going to be mark to market, if you like, in terms of looking at equities, in terms of looking at other financial investments, if you like. And as far as gold is concerned, of course, it will lose mark to market value. I'm talking about the currency losing mark to market value against gold. So this is why gold appears to be going up. It's not. Gold over long periods of time, going back even to Roman times, the prices in many things were really quite similar. There is some fluctuation, yes, but it's pretty minimal. Like it might double or it might halve, sort of thing. This is individual things, but basically, if you have a sort of a broad-based index of everything, measure it in gold, it'd be, it doesn't change. Mm-hmm. What does change, and this is where everybody gets it wrong, because they account in these paper currencies, what changes is actually the value of the paper currency. And this is why when we see gold going up, it's really reflecting the fall in the paper currency. But because so few people realize this, they will begin to realize it at a later stage. The thing that's fascinating is if you look at ETF demand, if you like, as a measure of sentiment in Europe, ETF demand for gold ETFs, physical gold ETFs, is pretty much negative in Germany. It's just not increasing. Also around Europe. And if you talk to the retail markets, and I think this is also true in America, you find that people who are hard pressed are selling gold and silver coins because they got to put bread on the table. There's a lot of that going on.
In today's news recap, silver to beat gold in 2025, Saxo Bank's Hansen. Diversified commodity exposure should continue to perform well in 2025 as a hedge against inflation and economic uncertainty. Specifically, gold and silver are expected to outperform the sector. Despite the bullish outlook in his 2025 forecast, Ole Hansen, head of commodity strategy at Saxo Bank, recommended that investors be discerning as they build a commodity basket within their portfolios. Gold and silver remain two of his top picks after their historic runs in 2024. Hansen said he forecasts gold prices to rise to $2,900 an ounce this year, representing a gain of 7% from current levels. However, Hansen sees even more potential in silver, projecting prices to reach $38 an ounce, a gain of nearly 30% from current levels. He added that his outlook is skewed to the upside. Looking at gold, Hansen noted that the precious metal will remain an important safe haven asset through 2025. The demand for investment metals has been fueled by an increasingly uncertain geopolitical landscape where global tensions and economic shifts have led investors to seek safer assets, a development that shows no signs of fading anytime soon, he said. Additionally, concerns about mounting global debt, particularly in the United States, have prompted investors to hedge against economic instability by turning to precious metals. However, he added that investors will need to be patient as the Federal Reserve shortens its easing cycle. Currently, markets are pricing in only one rate cut this year, a sharp contrast to expectations from a few months ago. The U.S. central bank's hawkish stance could support the U.S. dollar, creating some volatility in the precious metals market. Now we'll show you the best clips of the latest interview, but first, like, subscribe, and turn on notifications. And more importantly, let's celebrate democracy's recent victory in America. We're running a 30% off sale at goldsilvermerch.com until the end of the month. We've just introduced price point t-shirts and new designs, so this is the perfect time to get your gear and support the local economy as well. Use the code PRESIDENT at checkout to claim your discount. Enjoy the episode.
I would say that the futures and forwards markets are doing what they should do. Basically, it's speculators taking a view on where the price is going. I mean, they're looking at it. They are inevitably looking at it as gold is going up because you're accounting in dollars or whatever. Okay. The answer, as far as physical markets are concerned in the West, is that sentiment is very poor. Nobody's really bought into this. I mean, they really haven't. If you look at sort of total, sort of portfolio exposure, it's probably less than 1% is exposed to gold. Now, given that gold is real legal money, that's an extraordinary situation when there is so much risk around with all the debt and everything else. It's bizarre. A lot of it is due to the fact that the Americans have run a very successful propaganda campaign trying to remove gold from the financial system. And so for the last 50 years, people have come to believe that rather than, the reality, the common law reality, plus the accounting reality, the difference between money and credit. So the sentiment just isn't there. And we're beginning to see a little bit of demand coming for ETFs. Now, I think that demand, I mean, we're seeing it more in America than we are in Europe, but I think that demand is from, investment managers, big investment managers, who are not necessarily buying into the concept of gold, but see that the price has been rising, et cetera, and this is something which makes sense to include in a portfolio, if you like. I'll put it no more strongly than that. So I think we're seeing that sort of advanced institutional demand. I mean, what tends to happen with a bull market, if we can just think in those terms rather than the true terms of, the relationship between gold and credit, what tends to happen is that you find that the speculators will begin to drive up prices first. You will then find that more serious players will then get in on the bandwagon, and the last people to play are the public, because they will have seen that something has risen and it's risen and it's risen and it continues to rise, and therefore you've got to buy it because it's obviously rising. It's obviously rising. This is the place to be, particularly if everything else is not looking good. So we haven't got that ETF thing, if you like, virtually at all, except for a few institutions who are beginning to adjust their portfolios. And I think that probably sums up the current situation. Gold has this additional factor that, ahead of the speculators, you've got central banks who begin to look at their reserves and the balance of reserves and all the rest of it, and they start adjusting things. Now, it is a common statement that the Central Bank of China, the People's Bank of China, has been buying gold. That's not the way to look at it. Actually, what they've been doing is dumping dollars. Now, that, if you understand the difference between the two, it tells you something extremely important. And this is in common with all the other central banks. And remember, they've been told by Vladimir Putin, who's had his reserves stolen by us, don't trust the West, don't trust their currencies, buy gold. He's pretty much said that. And, so you sort of think, these guys, I tell you, the central bankers I've met are actually pretty cute. Most of them do understand, sort of, if you like, the outcome for the purchasing power of foreign currencies, et cetera, et cetera. It's just they're not in a position really to do anything about it themselves. But, the fact that central banks continue to buy gold, in fact, they're pretty much cleaning out all the mine supply, tells you quite simply that these guys really are in the know. They're ahead of the speculators. The speculators can see it, so they go and buy. The poor old swaps and bullion banks, find that they're getting squeezed. I feel so sorry for them. I'm going to cry bitter, bitter tears. But I don't think we need to dwell on that too long. But no, I think it is a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies because they understand the difference between money without any counterparty risk and currency with counterparty risk. So what they're telling us is, hold on, this whole system is looking a bit dangerous. Let's put it that way. You could be right to look at it that way. It is extraordinary that here we are in, as you put it, a gold bull market, and the gold-silver ratio is looking at 89 times. I mean, normally I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does, and it hasn't. Now, it has actually performed more or less in line with gold, but what's happened is that this is because the gold-silver ratio has remained very, very high. I think we've got a problem here because if you go way, way, way back, silver, obviously, I mean, you had currencies which were exchangeable for silver. Sterling was one of them, for example, until Isaac Newton came along and things changed a little bit then. And also in America, I mean, that was the initial currency there. The money, rather, that was the initial money against which banknotes or bank deposits or whatever were issued. It is no longer like that. I mean, in our lifetimes, we've seen silver coins.
And that's Alasdair Macleod's take on the evolving role of gold and the BRICS nations' ambitious plans to challenge the global financial order. What do you think? Do the BRICS nations' master plan for a gold-linked system hold the potential to reshape the global economy, or are the obstacles too great? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more daily recaps. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.